going to go ahead and get started so you guys can get back to your normal job. So Robbie asked me to do this like 2 weeks ago, and usually I think of Lunch and Learn being a little corner over here with a few people, but apparently we have the whole ballroom today, so that's lovely. I'll give some background on myself real quick. My name is Jack Hemmelgarn, for those who have not met me. I am primarily the research director at the Co-Y Engine. Previously at Innosphere, I've been managing our research associate program. This is some of our research associates over there, primarily undergrad, graduate students who are helping Innosphere client companies in our programs, either by finding investors, fleshing out their pitch decks, competitor analysis, that sort of thing. Recently, we've hired Lucas. Lucas, do you want to stand up? Lucas is taking my previous job and leading the research associate team. So if you are a client company in need of research, Father Lucas, not me. We are super excited about this transition. All right, I'm going to do a little disclaimer and do not distribute. So we use PitchBook data. For those who are not familiar, we pay for PitchBook data, which is private market data. I'm assuming Robbie is going to distribute this deck. Oh, sorry, I'm changing the slides on my computer, but not on here. This is data we pay for, and if you rip off a graph from my presentation, from the slides from Robbie, and then go to present to 1,000 people, I'm probably going to get a cease and desist. So I would appreciate if you did not do that. If you have some sort of one-off research question or question about data, can everybody hear me if I don't use the microphone? Okay. I feel like it's very poppy.
Is that going to affect the Zoom recording though? You should be fine.
Okay, Robbie says we're good. All right. So if you have a one-off question on research related to VC, you're welcome to email me in that jack@innosphere.org. Personal background, I am a high-performing bum. I live in Silverthorne, Colorado, and ski most days, whether it's in the morning or night. But I do work a lot and really enjoy my job. Okay, who is a VC or a startup? Show of hands. Okay, keep your hand up if you're a VC. Okay, we got one. All right, so I'm just going to frame us up here on maybe a potential startup journey through the classes of funding that we might look at. So pre-seed, let's say you're an idea, you're raising from your friends, your family members, yourself, you finalizing your IP, working on customer validation, and maybe you raise 100K, 500K if you're lucky. Okay, you get through that stage, and you still haven't gone out of business, and you still have sanity, and you're still married. You get to seed. Seed is where we might start seeing more institutional investors, professional investors. Right now, we have deal size 500K to 1.5 million for seed. If you are in California, even here, I've seen seeds up to 8 million. So seed can really vary on what that means. Series A, this is kind of our scaling and growth round. Usually we see customers, some product market fit. This says 1.5 million to 5 million. I would say it's probably more around 20 million. And you're a startup and you get through your Series A. And for some miraculous reason, you do not need to keep raising. And you get to have an early exit and a corporate buys you, or a private equity buyout, or another exit transaction. And you return money to your investors and yourself. So that's sort of just framing that all. I'm going to ask if there's any questions on that before we move on. Okay, awesome. So the topic of today's Lunch and Learn is Wyoming and Colorado venture capital update. First, I just want to frame up what the U.S. venture scene looks like as a whole. So if we're looking at total U.S. venture deals, we're last year about 22,000 deals, down from our peak at 37,000 during the COVID era. And that's only a few thousand more than how many deals were in 2014. So our 10-year growth isn't super high. All right, if we move over to the number of capital invested, so this is the total deal value of all venture deals in the U.S. we had a down year for deal count and an up year for deal value. So deals are getting larger, and one speculation of that might be that VCs haven't returned. Yeah.
Quick question, is this inflation adjusted?
No, this is just raw. Yeah. So deal size is going up. Deals are going down. Investors might be more adverse to risk. We're seeing more growth funds, that sort of thing. All right, so this is data I pulled last night that was actually quite shocking to me. This is charting the number of VC funds that are registered in PitchBook. In the past 4 years, we see a very aggressive uptick going up to 800 VC funds. Now, I want to preface that this might not be true VC funds. This could be some weird SPV action going on. People are, let's say SpaceX, for example, there's more investors who want to be involved in that scene. And maybe a fund isn't actually a fund. It could just be some sort of vehicle to invest in something specific. All right, so we've got a large increase in VC funds nationally, which has resulted in a very large boom in what the total fund size is in the U.S. So that's the $346 billion is what all funds together in early stage, late stage, and general venture capital were valued at in 2024. And then below that, we see a dry powder sum. So for those who aren't VCs or not familiar with the term, let's think of dry powder as investable capital or capital that these investors are going to need to deploy. My main takeaway from this is that there's investors with money and it needs to be deployed, and they're looking for deals. I think it's always a difficult fundraising environment for startups, but I would say from this information, there's a lot of capital that needs to go somewhere. If the funds are closed and they have the money, they're going to want to do something with it.
Why is dry powder at the fund size?
So this is one sort of iffy area. So when we think of how data is reported to PitchBook, if you or I were a fund manager, we go in and usually fill out a form every year of how much dry powder, total fund value, and return. I don't know many fund managers who are good about doing that. So that's kind of why we have a low dry powder number or an estimated number. So that's one of the catches in the data.
So is dry powder what they kind of expect to invest here?
Yeah, so that would be capital that I would, from like a simplest term, that's capital that's available to invest right now versus the total fund value where most of that's probably already been invested. Okay, moving on to our neighbors to the north. Is there anybody from Wyoming in the room? Okay, I know you. Okay. All right, so thinking about where we're getting our data. So we're sourcing our data from PitchBook. This is just sort of to put things into perspective. For Wyoming, for the past 10 years, we're looking at about 362 companies that were involved in some sort of VC deal, and that comes across as 711 deals. For those who haven't pulled PitchBook data, which I'm assuming is most of you, this is a really small snapshot compared to other markets. So the data is a little wonky in Wyoming's difficult ecosystem to value or gauge based on PitchBook data. Starting off with total venture deal count in Wyoming. Since 2014, we've seen growth from 18 deals to 66 deals as of last year, if we disregard the COVID deals where everything's inflated. So as an ecosystem, we've seen a large amount of growth here. As a whole, not from Wyoming, I am based here, so I'm not going to speak for Wyoming. But as an ecosystem, Wyoming has been significantly more active in the past 2 years as previously. There's Silicon Powar in Jackson, there's startup Casper, there's startup Wyoming, there's initiatives in Gillette, Wyoming to support startups, as well as the university seems to be coming around to spinning out companies more effectively. Looking at deal value, in 2014, that's at 31 million up to 126 million in 2024. So again, a great amount of growth over the past 10 years. Some of this growth can be accredited to this guy in the back of the room, who is I believe you're a pre-seed seed. Yep, pre-seed seed investor based in Wyoming, investing in Wyoming startups. There's also been some programs through the state to get money to private fund managers. So there was small business money that was given to the state that could go into early stage private investment. Wyoming is a state that decided to bid out to private fund managers some of that money. So they are incentivizing people to, within the state, to become investors or bring in outside investors. All right, looking at median deal size. This is tracking what the median deal size is across all venture deals in the state. This is a really simple graphic, and if it was going down, I'd tell you it's bad, and it's going up, so that's probably a good thing. This also tracks really well to Colorado. So this is valuing what the median deal size is for VC deals. Why I say this is tracking to Colorado, we're directly south of Wyoming, and if you're looking at VC data, you might just want to look at Colorado to value your Wyoming startups. We're not far away, and we have way more data within the state for helping make decisions. All right, well, the colors kind of came through on this. This is looking at deal count by type. I included grant in here as well. So starting at the top in purple, we have grant, then later stage, early stage, seed, angel, and pre-accelerator type funding. For those who work in grants and the government, you might notice something around grant. In 2022, it drops off. That doesn't really track with IRA and money that was appropriated to go into early stage funding and grants and whatnot. So I would say that the grant data on here is probably lagged, and that's probably a lot larger from 2022 and so on. What this does say is that Wyoming startups are being effective at leveraging non-dilutive funding. And what I mean by that is, let's say you're going to invest $20 of your own money in a startup, and you need other money to come in there to help offset your financial input. If we introduce non-dilutive funding, it helps to de-risk startups, it helps to leverage private investment, and ultimately the goal is to stir innovation and technology. It also helps investors feel more comfortable about their investment. So that is a good sign that in Wyoming, they are being effective in leveraging grants. This is breaking it down by total invested capital by type. What we see here is, like, over 10 years, there's only 300 companies maybe in Wyoming that are VC backed. If we look at 2022 range, we have early stage investment happening. See, that's a larger section. 2023, we see later stage. That starts to expand. I would venture to say that this shows a healthy VC ecosystem forming. We have higher early stage deals happening the year prior, and then more later stage deals happening the year following. So startups are effectively raising and growing within the state. This is where the lack of data in Wyoming really shows when you try to plot things. I'm not even going to cover this. I'll say that this is median deal size by type, so breaking it down by later, early stage, or seed. I'm just leaving this in the presentation if you need it. I'm not going to cover it because it's pretty jagged. Okay, so if we break Wyoming down in venture capital terms and we look at verticals, these are the top 10 verticals from the state that by deal count of last year, and then they are sorted by change. The change could also mean it's going down. So starting off with the largest change in deal count is clean tech. Then we go to fintech. This is a lifestyle, wellness, big data, SaaS, climate tech, crypto, AI, manufacturing, and mobile. So a lot of these verticals, one, either need cheap energy, or two, don't like regulation. So it kind of lines up for Wyoming. But as you can use this as a reference chart of where verticals are going within the state. Yeah, usually I would have a capital invested slide after this of also charting alongside deal count, but it's a little floppy for Wyoming. Okay, looking at Wyoming's largest deals in 2024. Our largest deal in Wyoming is 18 million, which is really small for venture in today's world. Heirloom, I'll give a shout out to, is a former client company of Innosphere, and they're doing a type of, is anybody from Heirloom in here? No? Okay, then I'll speak to it. Basically, it's a alternative to building large wind turbines. They're lower to the ground, so, less maintenance costs, less infrastructure costs, et cetera. I'm not gonna go through all these deals. You're welcome to do that with us later or now. The only funny one in here is that there's a restaurant and bar. It's not typically what we would think of for venture backable. All right, let's look at Colorado. So we have a Colorado venture report coming out, created by the individuals on this side of the room. When is your report coming out? Soon. Soon. All right. Soon. I would look on LinkedIn for a more granular and well thought out report and not me. That should be coming soon. Okay, so just a data overview for what we were able to look at for Colorado. We're looking at 3,400 companies over the past 10 years that are VC backed, about almost 8,400 deals. So that compares to Wyoming's 311 companies, and we have 3,400 companies. So we're a much more developed ecosystem with a lot more data. This is looking at venture deal count. It is a little concerning that our deal count is almost no growth if you just go 2014 to 2024. But we are attracting capital to the state. So we have had growth from $2 billion invested capital to $5 billion over the 10 years, and then along with a mega year of $11 billion in the COVID era. So we have seen a good amount of investment. One thing I'm going to touch on here that's not in this presentation, compared to other ecosystems, Colorado is extremely dependent on out-of-state investors. If you plot it out, it's probably like 1 in every 10 investor is a Colorado investor in a deal. So from a challenge of a state is growing our homegrown venture ecosystem and homegrown capital that we're investing within the state. If you ask why that matters, one, your neighbor understands your challenges better than somebody across the country. If we have local investors that are connected within the ecosystem, they can be effective partners to these startups versus just a check. Okay. Yeah.
Do you think that's a lack of Colorado investors, or is it just more powerful?
Yeah. So that's do you guys have a data-driven answer to that before I?
Could you repeat the question, please? Sorry.
The fact that there's so many outside investments coming into Colorado, is that a lack of investors funding being available and dry powder being available here in the state, or is it that for a Colorado entrepreneur or startup, investment and returns from an outside investor, especially Silicon Valley, are more attractive?
I think that stems mostly from the different ecosystems. You have a lot of concentration on the coast in terms of capital, I think it is just a lack of funding and a lack of investment in the state.
Yeah, and where a lot of our homegrown capital is tied up is in growth stages or just other private market funds. And there isn't a huge early stage. I mean, we have Techstars, or we have and then we haven't. So, I mean, that's a huge driver of early stage funding within the state. But it's also, you know, if I drive a Prius and the guys in California have a tank, if we're just thinking about size of the fund, it's kind of hard for us as investors in a group to compete against that. I mean, it's a great steal if you're a California VC and you come to Colorado in terms of valuation and how much of the company you're able to buy up and how much further your money will go.
I think also just the shift from the 2023 to 2024 lack of investment.
Yeah.
Investors are looking more for profitability in companies versus high growth and venture back, which is what you're seeing on the
Yeah.
So they're coming more to more internal in the U.S. or companies that are actually profitable versus high growth.
Yeah. Instead of buying up domain names and selling them. Awesome. All right, we'll just move on to median deal size. This is, yeah, go ahead.
So basically, look at those last couple of things. It looks like, you know, 2021, 2022 are kind of anomalous years that are very, very high.
Yeah.
And where we are now, both in Wyoming and Colorado, invested amount pretty much like pre-2021.
Yeah.
$5 billion. But the deal size is a lot bigger than pre-2021.
Yeah.
Why is that?
My opinion is that investors are just, they're more adverse to risk right now. I mean, in terms of venture funds, from what I've seen on benchmarks, returns aren't anything to really write home about or that their LPs are probably happy about. And I think people are a little more conservative on where they're throwing money right now. They want to be more sure about it. So they're looking at further along companies, which are ultimately all right, median deal size is basically tracks the same as Wyoming. We're up to about 2 million now, from like 0.75 in 2014.
So does the median deal size, that covers all stages?
Yep, all stages. So this could be the $25,000 check from your parents, or the $300 million one from a coastal VC. So just as a whole holistic view, it's really just a tracker of what direction we're going. All right, this is a same chart as previously in Wyoming, but for Colorado, breaking down deal count by type. As you can see, this is looking at deal count. So the fact that these are all kind of spaced out, one's not getting super skinny and they're not fluctuating a ton, is a good signal of a healthy ecosystem here. In the most simplest terms of that, you know, there's 50 early stage deals and then there's 25 later stage deals that continue on. We also have a lot of grant deal types. Colorado has the Advanced Industries Grant Program, and the universities in the state that are supporting spin-outs are quite effective at receiving grant funding, as well as investors like to do that.
When I look at these bars, obviously grants have dropped off, and you addressed that already. You know, that may not,
Yeah.
the last couple of years may not be good. But I also see a drop off in the width of the bars with the pre-seed. What's your accelerator type funding? What's your thought on that? Why that's dropped off the last couple of years?
Yeah, so we're looking at the light blue down here where it's dropping off. That could be one. So us as an accelerator incubation program, we don't actually write checks. So that's just, want to make that clear. For here, this could be Techstars leaving. It could be that, you know, founders might have been discouraged in the 2022, 2023 years after everybody was just getting checks, and then investors were more conservative and it was harder to fundraise. So maybe they weren't actually, you know, looking to go to market yet or pursue their idea. Maybe they said, you know what, I'll wait 2 years, I'll wait a year, and then they didn't go into an accelerator incubator program. But overall, I would say, you know, that sort of is tracking this decline down from the peak during COVID. So, I don't think it's an anomaly out of the entire market. Any other questions on this one? Okay, this is breaking it down by capital invested by stage. The proportions of everything track well. You have seed down at the bottom, then going up to early stage, then going up to later stage. Ideally, we would see in a healthy ecosystem, seed would be the smallest, and then we'd see some growth in the early stage when larger checks are being written. And then in the later stage, we're going to see a larger chunk as we would see compared to early stage just because of larger check size. As well here, good amount of grant funding that was awarded during the COVID era. I will say again, I think this is lag. IRA appropriated a large amount of money that is available to startups, and that was 2022. We don't see that here. So I do think that there's more grant funding in these more recent years than what's being reported here. Okay, this is median pre and post valuation. This is, let's say, let me see what the range of numbers is here. You know, let's say I'm raising $8 million, and today I value let's say I'm raising $2 million, and today I value my company at $15 million. Then I get some more money, and then my startup is now the post valuation, which is generally the deal size, plus the pre-money valuation. This is a good reference that will be in the deck for those who need it. This is aggregating all deals across all VC stages. What's good is that this is not going down further. You know, we saw this large spike in the COVID eras, and then we went down a little bit to a correction, and then last year we're going back up again. If this were to keep going down, for example, what that means is founders are likely giving up more of their company for money. So money is getting more expensive, and that's not great for founders. What this does say is that, you know, the founders and the startups might hold more of the power than the investors. You might be able to negotiate better. All right, moving on, we have Colorado median deal size by deal type. Seed looks great. It's an easy, simple line to follow. Our early stage and later stage lines are very wonky because not all VC deals are created equally, or do people want to follow a trend? So, you know, there's huge early stage VC deals, and, you know, sometimes there's little later stage VC deals. This is sort of just an overall trend. I generally only look at the seed one here, and we are growing as an ecosystem. Okay, looking at Colorado's top 10 VC verticals. So in terms of, you know, growth, AI, climate tech, fintech, health tech, and clean tech have had the largest amount in this category, in this pool of verticals over the past 10 years. Below that, we have big data, lifestyle wellness, manufacturing, SaaS, and life sciences. As an ecosystem, in my opinion, these seem like good verticals for us. You know, climate tech, in clean tech, we're a state in the region that suffers disproportionately sometimes to the climate and challenges that our world faces today. Health tech and life sciences, you know, we've built up a great ecosystem in the area that's been able to support those technologies. And manufacturing is a new one for me. If anybody knows what's going on in manufacturing in the state, I would love to hear from you. All right, this is the same as previously. So previously on our verticals, we're looking at just raw deal count, how many deals were happening in each vertical. This is tracking invested capital over the 10 years. So lifestyle and wellness, we've seen the largest jump in invested capital I think that one's pretty straightforward. We're a state that's pretty fit, and people like to go outside. So, you know, these types of companies are found here. Climate tech, clean tech, I think those are also self-explanatory. We've got N-Rail, we've got great test beds and assets and support in this region to accelerate those technologies. And then moving further down with fintech, health tech, manufacturing, life sciences, SaaS, AI, and big data. All right, so Wyoming, I did not include anything on VC-backed exits. What I mean by VC-backed exits is it's a VC-funded company, and one day, your VC is gonna want their money back. So you need to, you know, in the simplest terms, sell your company so they get their money back. In Wyoming, there haven't been great examples of VC-backed exits yet. Colorado is a more mature ecosystem, so we have data on it. What we see here is, you know, there isn't a huge rise in it, but it's not going down. And thinking of M&A markets that might fluctuate, this seems to be pretty healthy and follow, you know, somewhat of a normal exit cycle of, you know, there's years where companies are acquiring, there's years where companies are holding money. So if you're a Colorado company and you're looking to exit, you're not choked out. Just looking at the state of what our exits have looked like, M&A is the most popular exit, which is probably pretty obvious to a lot of people. So out of the past 10 years, 61% have been an M&A transaction, 16 have been some sort of buyout, 9% have been IPO, 10% add-on, and then it's like 4.1% have been other. Okay, this year, these are our largest VC deals that are within PitchBook. If you know of a larger VC deal, maybe the number wasn't disclosed or it's not on PitchBook yet. Quantium, I believe is how you say this, is a quantum computing company. They were the largest sole round of $300 million raised for early stage. And Vita Biosciences raised $304 million last year across a B and a C round. Loma, I believe is how you say that. They're some sort of green hydrogen play that raised $246 million in the Series B. And then AMP Robotics, which is actually an Ionosphere past client company, they've raised roughly $200 million last year. Quantium, I'll speak to as, we have just been designated as an EDA quantum tech hub. So we have an ecosystem player now called Elevate Quantum that is dedicated to accelerating quantum technologies within the state. So it's great to see a large quantum raise. AMP Robotics, I'll just talk about this one because I think it's cool. If you don't know what it is, basically they have a robotic arm and a camera system that sorts recyclables in plants because nobody really wants to do that. The turnover in that job is high. And the precision of a human is way less than a robot in sorting recyclables. Awesome. All right, I'm going to open up to a Q&A. I left a lot of time for a Q&A, so happy to answer questions.
I have a question, and one of your slides you understand angel funding.
Yeah.
Before seed funding. So could you describe the difference?
Yeah, so within PitchBook, this gets a little sloppy of what angel or seed funding really means. So in the eyes of, you know, us, I would think of an angel as an individual who writes checks. Seed, typically an institutional venture fund is writing a check. In PitchBook, it's really difficult for them to separate what's what based on tagging in the deals, because obviously an angel funder could be involved in a seed deal, even up to an early stage or late stage deal if they wanted to be. So in terms of what is the difference, is that your question? Yeah, so in terms of the difference, angel, I would think individual, high net worth individual who writes his own checks, or her, or them. And seed is probably an institutional VC, as in there's a fund that's managed by people and they go out and they raise money from limited partners to invest their money. So just a few different vehicle types there.
The interest rate a few years ago that banks were paying was 0.5% or less.
Yeah.
And today we get CDs for 4 to 5%. So obviously people are like expecting a bigger return on their money today.
Yeah.
How do you see that impacting the VC investment options?
Yeah, so this is, in terms of a you know, for how VC fund, the life cycle of a VC fund, let's say it takes, I'm just gonna paint this in the simplest way I possibly can. We're gonna start a VC fund. It's gonna take us, let's say, 1 year to 2 years to raise our $30 million VC fund. And then we go out, we pitch all these people about how they should give us money because we're the smartest people in the world on how to invest their money. They sign term sheets, they sign LPA agreements, and then they're committed to putting their capital into our fund. Our fund has a life cycle of 10 years, where we can call capital down from those investors in our fund to ultimately invest in startups. So if we think about interest rate fluctuations on a year-to-year basis, yes, people move their money around, so what's best? But in terms of VC, LPs are locked in for 10 years usually. So they don't have the liquidity or the flexibility to just up and go change what their investment strategy is. So generally, this is probably a bad thing I'm saying this, I don't really think about interest rates, but it definitely, in my opinion, has an effect of what the fundraising environment looks like today, versus what it is in a few years. I think it matters when you're going up to somebody and asking them for money to put in your fund and what the rate is right then, because they're just comparing 1 to 1. If they've already committed, they're kind of locked in simple way to put it. So that was kind of a long answer. So I don't think it's affecting existing funds yet, who might be locked, their capital's locked. But if you think about the fundraising environment today, I think there's going to be some difficulties on people, one, not wanting I would say who feels like we live in an uncertain time? Okay, so I think investors would feel the same way. And having your money locked up for 10 years, theoretically, or maybe not seeing any return from that for 6 years, that's probably going to make it difficult for fundraising. That's my opinion on it. I'll go, you're first.
Give us actual rate of return for these venture funds. They haven't been doing so well.
Yeah, so I do have benchmarks, but I can't get them up here fast enough to really make a difference. What I would say is that, in a generalized term, I think emerging managers, so let's think funds that are 30 million or smaller, thought they were going to do a lot better and pitched LPs that they were going to do a lot better. The larger funds, it's a numbers game. You know, if it's a $2 billion fund, you're making so many investments, something's going to pay out. So I don't have the return numbers off the top of my head, but I would say, as a whole, from the most recent benchmark numbers I see, the smaller funds and the newer managers I don't think they're returning what their LPs expected as of right now. Maybe they will in 5 years, but I think there's a lot of people going to LP meetings right now and justifying, what's going on.
I mean, my question was actually really similar to his, just around, you have deal count, deal size, exit count, but nothing with like exit valuation or something to even deduce a
Yeah, so exit valuation is a little tricky because you get such a big spread from like a small M&A of 100 million to an IPO and where the money is actually flowing. So in terms of exit value, does anybody have you have that up? I can pull it up really quick. Or just give me one question. Is there another question while he pulls that up?
Yeah. How do you see the preference, if you will, of venture capitalists? Are they interested in intangibles like quantum computing, or are they interested in nuts and bolts stuff, you know, products you can actually pick up, turn over in your hand, and offer to a customer in a physical way?
Yeah, so I think there's an investor for everybody. But right now, I would say there's a lot of things being invested in that are really far out ideas, and they're getting a lot of money. Let's think of fusion, some new, or quantum, for example. I mean, quantum is attracting a large amount of money. A lot of this is driven by, you know, philanthropic billionaires funding these technologies. I mean, if you look at a lot of space tech has more short-term potential than fusion, for example. But for these really far-reaching ideas and technologies where the maturity is super far out, I mean, there's money out there for those. Consumer tech, for example, there's angel groups, there's a lot of VCs that specialize in it. And then, you know, there's a large amount of clean tech, deep tech investors as well. Especially here, there's a good amount of deep tech investors. And when I mean deep tech, I mean thinking of a climate solution that's a physical asset that'll take 10 years to develop. You know, it's not a consumer product where we go spin it up in a factory and can start selling in a year. So I don't think there's an overall preference. It kind of comes down to the VC. On that, I also have seen recently some, I don't think this is a new thing. There are some VCs who, they have an idea of what will be the next thing, and they will either go fund it or they will architect the company to form. So there's some of that going on. It kind of just depends on the person. I mean, if you think of the investor of you, you're probably going to invest in something that you're knowledgeable in, versus something you have no idea what you're investing in. So it just kind of comes down to who the partners are on funds and what they want to invest in.
So per exit for the last 10 years, the median exit value in Colorado is around 34 million, which that includes outliers at all stages.
Yeah, and there's some, does that include the secondaries in there too? No. So, I mean, that includes a lot of exit types and a lot of different deals that could not be the full company being sold. So that's probably why it's so low.
And all the vertical trends, the deal counts, and those sorts of things, they look fairly similar from a high level, but when you look at the count, SaaS is still significantly higher than most.
Yeah.
Do you see that changing? Do you see that still staying that?
Yeah, I mean, I think people are more hesitant from a fund perspective to invest in SaaS because of how valued SaaS has become. Meaning you're getting less of the company. That being said, if you model out and, you know, the performance of SaaS over the past 10 years, I think it's hard not to sell that to somebody you're trying to get money from to invest. I mean, I don't think SaaS is going away, and I don't see a decline in SaaS.
This is an anecdotal observation. We're a spin out down at CU, medical device, and I've been to a couple of open pitch events in the last few weeks, and in the life science medicine, the number of people pitching and people requesting to pitch in these events has just skyrocketed, and everybody they're kind of thinking is because there's so much up in the air about NIH grants right now.
Yeah.
I know we're getting ready to apply for the NIH grant in April, and people at NIH have no freaking clue what's going on.
Yeah. Is there anybody from the USDA here? Apparently their grant budget is going up, is what I heard most recently. I don't know how that one's working, but I mean, I think a lot of people, I mean, us as an organization as well, I mean, we're a nonprofit, so, and we're supporting early stage companies that typically need non-dilutive funding to de-risk, so I would say I could definitely see startups right now being cash grabby and wanting to weather the storm, so to speak.
To say, separate Colorado and Wyoming, other new areas, fair enough.
You mean
Right, coast or otherwise, but
like
whether in verticals or otherwise.
when you say no coast, you mean other central US?
Yeah, so we're not
Okay.
talking Silicon
Yeah.
Valley and New York money, but
So if we think about, I'm just thinking like central, Mountain Plains region of the US. Who here wants to move to Nebraska? Who here wants to stay in Colorado? Do you think this is a smart group of people in the room, yes or no? I'm gonna go with yes. I think that's probably a large portion of it. It's just based on population and who the people are in that population. I mean, historically, as a state of Colorado, I mean, intelligent people who are, you know, driven to do things and move to the state and stay in the state. And I think that's a big part of why, you know, we've had this earlier success in the startup ecosystem. As well as from a university perspective, we have CU, Mine, CSU. We have CU Anschutz around medical devices, Mine, you know, they're a great deep tech partner, in terms of mining, or just green technologies. We have NRail. I think we have the highest concentration of national labs within our state compared to other coasts. Somebody's welcome to correct me on that if I'm wrong. So I think that's kind of what my differentiator is. I mean, for deep tech assets for a central state, I think we have great resources.
Sorry to monopolize. I'm trying to figure out where my own startup fits. Sometimes that's where it's hot.
Yeah.
So, you know, let's say I could call it, clean tech, I could call it climate tech, I could call it manufacturing. Which one would be best? Which one would be most attractive?
Okay, well, I don't know what you're doing, but you want to give a 30-second elevator pitch on it?
I absolutely do. I've developed technology to reduce the cost of growing indoors, and I don't care what the product is indoors, but to reduce that cost by as much as 2/3 over the legacy way of doing it.
Okay, and we're thinking like indoor farming, is that what you mean by that?
That's right.
Okay.
Yeah. Think of growing cannabis, but also many, many other things, because if you reduce the cost that much, other things become far more profitable.
Yeah.
You know, leafy greens and basil.
Yeah,
Sounds like egg tech to me.
yeah, I mean,
Could
in
be
terms
egg
of
tech,
what it is,
Could
I
be
would,
clean tech, because of saving energy.
yeah, so I mean, I guess in terms of, you mean how you market, are you asking how you market yourself to investors or to the public? I would say you kind of do a mishmash of all that. I mean, intelligent investor, once you pitch them the idea, I think they're gonna see it fit in where they see it fit in, of what their vision of the product might be. I mean, ideally, they're supposed to be smart people, so they should have a good roadmap themselves of what they think the technology is. In terms of, you know, getting a meeting with an investor and that sense of marketing, you know, I would just go in line with what their thesis is. I mean, if it's a ag tech investor, go with ag tech, and if they're an impact climate fund, go with that. And if it's something that's, you know, more along the lines of something else and a different vertical, go with that.
2 questions.
Yeah.
First one, where and how does PitchBook get the information you guys have?
Yeah. So it's a mix of self-reporting and web scraping. So web scraping could include government records. It could include press releases. So if I made an investment right now and put out a press release on whatever, Global Newswire, and said, X fund did $3 million investment in X company, their web scraping will pick it up that way and then tag it as a deal. There is also some like SEC web scraping that goes on, and then as well as self-reporting. So a lot of the the startups are generally better about filling this out. So if you have a startup and you've raised 3 million, if it's not in PitchBook, you might request to put it in PitchBook. That makes it searchable theoretically for investors to kind of gauge where your company's at. A lot of larger VCs will use PitchBook for sourcing, or to track more mature startups. So it's a mix of web scraping and self-report.
The second question was, does Innosphere have any matchmaking VCs and startups?
In terms of, if I'm a VC and I give 100K to the, or.
No, like a program where you match startups with
Okay.
VCs and.
Yeah, so we have a program called Meet the Investors. I think we do that like every month, Ravi?
Yeah.
Okay. Yeah, so I think about every month we have an investor kind of come in and, you know, pitch themselves as an investor or talk about what they do. So that's one way we sort of help match startups. For our client companies who are within our programs, one, we can search PitchBook for investors that might be ideal and try and help connect you through our network. So we do sort of matchmaking, but it's not like I have an internal tool where I can whip it out and.
Like Tinder.
Yeah,
Yeah.
we haven't developed Tinder for that. Yeah.
Could be a,
Yeah. All right, any other questions? Yeah.
Yeah, I think last question, just from your perspective with Innosphere, what's the so what from the data? Like, how does this guide you guys going forward?
Yeah, so I would say, well, I'm not Mike, our CEO, but I would say from an organizational, you know, mission, one, we want to develop technology in this state, and our data suggests that we can do it with the money we're attracting to the state now. Why I say it like that is, you know, let's say we want to go after a large government ecosystem project where a federal entity might give us 100, 200 million to do something. This is data I would show them and say, look, we're not starting from ground zero. We already have this investment. We've been able to track this way. If we bring in this federal money, we can make a correction, so to speak, and push it further up. Secondly, I didn't put the data in here, but as a state, our homegrown capital is low, and that's something that we've talked about for years is, you know, how do we get homegrown capital in the state and keep it here? And that's something we've kind of pushed a message on to OEDIT, which is the economic development organization in Colorado, and that sort of thing. So my one-liner for that was, we're an ecosystem in the central U.S. that's not a coast, that if you go to a coast, they might not have heard of the state Colorado, but we have an ecosystem where you can actually grow a startup and have a healthy life.
Quick follow-up on that though,
Yeah.
why is it bad that you're looking at in-state funding low? Because if the startup is in-state, is it not beneficial that there's out-of-state money coming in?
Yeah, so there's a few thought processes on this. Primarily, it's just activity within the ecosystem. You know, if we talk about investor matchmaking, it's much more likely that I know the investor in the state than I know the investor on the coast. This also comes into play of, you know, how do we secure follow-on capital? Because it's usually not just a one check and done sort of situation. So ideally, in an ideal world, and a lot of investors pitch this, your investor is a part of the company, or your investor is actually doing something more than writing a check. Some investors are transparent if they're just writing a check. But the investors who are local, theoretically, in theory of everything, are going to be a better strategic advantage to helping those startups in the ecosystem. You know, if we think about let's think of a deep tech investor in Boulder. They have connections to all the national labs. Maybe they were in Techstars or something. You know, they're supporting a pre-seed company that needs to have a test bed or pilot project that N-Rail could help with, CSU has test beds, that sort of thing, that just in ecosystem connection to help accelerate technology quicker. That, I think that's one of the main reasons why in-state money is beneficial. I know exactly what you're saying, from theory of just like raw economics of like money in versus money out, that checks out. But if we're thinking of, we're growing startups to have returns of 10x plus, does the $250 check from out of state flowing in really matter?
Yeah, it might be interesting for future data though, then to have like, what was that participation? Because if there was a lead investor in
Yeah.
Boulder, that's the one that you're working with, you get that expertise, but then you bring in 10x the money from Silicon Valley.
Yeah.
That seems.
No, I totally agree with you, and I think we'd have to pay a lot of money to PitchBook to have them structure it that way. Okay, so it is almost noon, so if you need to leave, you're welcome to leave. I will do like 2 more questions max if there are any. Okay, awesome. Or do you have a comment?
I mean, I was just gonna give you the numbers for profit investment. In Colorado, in 2024, 1.3% of all capital invested came from Colorado, and 86.2 came from out of state. So like,
Well, that doesn't add up to 100.
Where do you get that free
Well,
money?
guys, he's a finance, he's finance, not math, so.
Thank you.
All right, thank you everybody for joining us today.